Welcome back to the channel. Look at the screen for exactly 1 second. Silver is currently trading at $76.77 per ounce. Gold is sitting at $4,700. Now completely erase those figures from your mind. The nominal price flashing in front of you is a deliberate distraction. It is a daily technical fluctuation layered over a massive structural transformation actively reshaping the global asset hierarchy. Most investors will fundamentally fail to read this market. They will fail because they are hopelessly fixated on the numerical value on a digital chart instead of analyzing the underlying architecture. There is a violent rotation underway inside this market. It is not a theoretical model. It is mathematically measurable. It is producing absolute signals that reveal a profound shift in global wealth and resource allocation. The government-managed floor beneath this physical market is reaching the absolute end of its operational runway. When it ends, the repricing will be immediate and severe. Right now, it costs approximately 90 ounces of silver to purchase one single unit of the standard Anpor's 500 index. That is 90 ounces of physical, unprintable metal required to buy the most heavily referenced stock index in the history of American finance. Pay close attention to the undeniable trajectory of this ratio. In 2024, that exact same purchase required nearly 200 ounces. In 2025, the average dropped to around 150 ounces. Today, a mere 90 ounces will execute the transaction. In under 2 years, silver has compressed the cost of the premier equity index by more than half. This is not happening in fiat dollar terms. It is happening in real, physical, non-counterparty terms. This single mathematical ratio dictates exactly where this market is heading. In 2011, at the absolute peak of the last major precious metals bull market, it took just 36 ounces of silver to buy the index. In 1979, that number plummeted below 10. In 1932, it fell below 30. Silver has already executed a genuine, mathematically measurable move relative to equities. The ratio has compressed from nearly 200 ounces down to 90. That reality is undeniable, yet the market is still sitting at 90. That is more than 2.5 times higher than the 36 ounces of the previous cycle. It is more than 8 times higher than the most extreme historical baseline readings. What this ratio guarantees is that silver remains deep in the early innings of a generational repricing event. The price today is merely the starting line. Examine what this rapid compression is already achieving regarding the position silver holds in the global asset hierarchy. Silver has violently moved from the 8th most valuable investable asset class on Earth straight to the 3rd position in approximately 2 years. For decades, silver was treated as a commodity footnote, while serious institutional capital flowed heavily into technology, broad equity indices, and fixed income vehicles. That reality has now completely shattered. During the last major precious metals bull market, extending from the early 2000s through 2011, the percentage of total global exchange traded fund assets allocated to gold climbed from between 2 and 4% up to a peak between 7 and 8%. In absolute concrete terms, for every $100 managed in these massive funds, 7 to 8 of those dollars eventually found their way into precious metals. That represents the true scale of a mature institutional rotation. Today, even with silver commanding the 3rd position globally, the institutional allocation to precious metals funds sits at a stagnant 2% of total global assets. That is the exact same depressed level recorded at the absolute trough of investor interest in 2022 and 2023. The underlying prices have moved significantly, but the massive wave of institutional allocation has barely begun to follow suit. If this current cycle mirrors the established dynamics of 2009 to 2011, institutional flows into precious metals have 4 to 5 times their current volume left to deploy before they even approach prior peak allocations. When capital of that staggering magnitude attempts to enter a physical market strictly constrained by geology and declining ore grades, the absorption process is violent. It is violent because the physical market is exponentially smaller than the tidal wave of fiat capital trying to squeeze into it. We have not yet reached that point of violent acceleration. To understand exactly why it is imminent, you must understand the mechanical trigger that fires institutional rotation into precious metals. There is a single, undeniable economic condition that has reliably preceded every significant precious metals bull market in modern financial history. It is a precise mathematical threshold. Real interest rates turning profoundly negative. Real interest rates are simply the difference between the stated yield on a government bond and the actual rate of inflation. When yields exceed inflation, holding government bonds earns genuine purchasing power. Capital stays parked safely in sovereign debt. But the absolute moment inflation overtakes the yield, holding government bonds becomes a guaranteed, mathematically documented losing trade. Capital is forced to abandon debt and find a reliable store of value that central banks cannot digitally debase. Historically, and without fail, that capital finds gold and silver. In 2002, this precise threshold was crossed for the first time in 22 years. Silver was trading around $4.50 per ounce. Gold was barely above $300. Nobody in the mainstream financial press was discussing precious metals. Then, real rates went negative. What followed was a massive 9-year bull market that caught conventional investors completely unprepared. Look closely at the macroeconomic reality today. The official inflation rate is surging back above the official yield on 1-year Treasury bonds. Real interest rates are rapidly approaching deeply negative territory once again. Simultaneously, the Federal Reserve has been aggressively expanding its balance sheet for 8 consecutive weeks. That is 8 straight weeks of pure, unadulterated new money creation. That is massive monetary accommodation occurring in an environment where structural inflation is already highly elevated. The exact same historical trigger that fired in 2002 is reactivating right now before your eyes. There's a critical, unprecedented distinction between this cycle and the previous one. In 2002, the global silver market had 0 sovereign-level buyers operating with a programmatic mandate to accumulate physical metal. This time, 2 global superpowers are actively purchasing silver simultaneously. This dynamic changes the fundamental character of this market permanently. The first sovereign buyer is China. In March of 2026, Chinese physical silver imports reached an all-time unprecedented record high. This volume was 10 times higher than the established seasonal average for the month of March. A 10% deviation from seasonal baselines is considered significant. A 50% deviation is highly alarming. A tenfold deviation is a massive geopolitical signal. It represents a sovereign entity making a calculated strategic decision. This is crossed out of normal commercial procurement and squarely into strategic global resource control. Furthermore, silver was actively trading at a premium inside China relative to Western spot prices. When a buyer operating at that enormous scale willingly pays above the global benchmark, they are purchasing because immediate physical availability is their concern. China fully understands that securing the global silver supply chain is a fundamental national security operation. It is absolutely critical for advanced avionics, hypersonic weapons guidance, communications networks, and next-generation radar systems. The second sovereign buyer is the United States government. The United States has aggressively entered the physical silver market after a devastating 26-year absence. In 1999 and the year 2000, the United States incredibly and recklessly liquidated its entire strategic national silver stockpile. Every single ounce was sold off. 26 years later, the nation is desperately attempting to reverse that catastrophic decision at a far higher price point in a far more competitive environment. In November, silver was officially and permanently added to the United States critical minerals list. The physical market responded immediately. Silver crossed the $70 per ounce threshold for the first time in December. Since that moment, it has closed below $70 on exactly 4 days. That equates to 95% of all trading days holding firm above the $70 line. This price action is not driven by fickle retail momentum. This is the direct result of Project Vault, an official United States government initiative covering 60 critical minerals backed by a $12 billion committed budget. The strict mandate is to urgently rebuild domestic strategic stockpiles. The empirical evidence is not theoretical. One of the largest domestic silver producers recently reported realizing $70 per ounce against an average global spot price of just $55. That massive $15 per ounce differential is a direct contract payment. It is the literal United States government price floor appearing in public reports. Additionally, public congressional disclosures reveal active accumulation by politicians sitting on the relevant subcommittees. The Pentagon has formally partnered to construct a massive new metals processing facility in Tennessee, specifically designed to process silver and other critical elements. You are now competing directly against 2 sovereign-level buyers armed with virtually unlimited fiat currency. China is aggressively importing at 10 times its seasonal average. The United States is methodically executing a $12 billion accumulation program. Amateur analysts argue that if the government is actively managing a price floor at $70, the ultimate price is also capped. This logic is completely flawed. Project Vault has exactly $12 billion officially committed across 60 separate critical minerals. The per metal budget is strictly finite. At the current aggressive rate of sovereign consumption, that budget is not a permanent market fixture. A buyer constrained by a finite budget eventually runs completely out of budget. When the allocated silver budget is fully exhausted, the government abruptly stops buying. The artificial floor immediately disappears. The market price then violently finds its own clearing level in a structurally deficit market. The physical supply reality guarantees the mathematical price target is absolutely inevitable. The global silver market has systematically consumed more physical silver annually than the global mining industry produces for several consecutive years. This severe deficit has stubbornly persisted with no meaningful new mine supply. The widely publicized 3% decline in silver demand from the solar power sector is irrelevant noise. A minor 3% reduction does not resolve a massive structural multi-year deficit. Modern defense applications of silver are among the most intensive uses. Unprecedented global defense demand growth will completely absorb the temporary solar reduction and aggressively push net industrial demand into rapid growth. The replacement is already mathematically scheduled. Let us meticulously calculate the true clearing price. The critical silver to index ratio currently sits at 90 ounces. At the 2011 peak, that exact ratio reached 36 ounces. We face two distinct macroeconomic scenarios. Scenario 1, the broad index pulls back sharply toward its 2025 lows, resting at approximately 4,800. If the ratio compresses to 36 ounces, silver is mathematically priced at $134 per ounce. Scenario 2, the Federal Reserve continues aggressively expanding its balance sheet and slashes rates. The index holds around 7,000 on monetary support. The resulting hyperinflationary environment still violently drives the global rotation into hard, tangible assets. The ratio still compresses to exactly 36 ounces. Under these conditions, silver is mathematically priced at $194. Both highly probable scenarios produce a definitive silver price ranging between $150 and $200 per ounce. The current data for exchange-traded funds confirms this exact timing. The ratio of speculative bets against silver versus bets positioned for silver has shifted from 84 hundredths down to 53 hundredths. For every single bet placed against the price, approximately 2 bets now sit solidly supporting it. This is the textbook definition of early-stage systematic accumulation firmly anchored at the $70 support zone. This structural recovery phase perfectly projects a massive acceleration event between September and October of 2026. That is exactly 5 months from today. Over the past 5 years, as physical silver has steadily appreciated by 180%, the basket of primary silver mining companies has appreciated by only 93%. Producers have drastically underperformed the actual physical metal by nearly half. This massive valuation gap absolutely does not persist indefinitely. Consider a mining company producing physical silver at an all-in sustaining cost of $50 per ounce. At an $80 realized price, the profit margin is strictly $30. At a $150 realized price, the profit margin violently expands to $100. The underlying metal moves 75%, but the pure profit margin explodes by more than 200%. That is the true operational leverage the sector is carrying right now. The market is currently holding 5 years of tightly coiled, accumulated underperformance, desperately waiting to mean revert. Two distinct risk profiles exist. Physical metal captures the structural price move directly with absolutely zero counterparty risk. Mining equities carry the documented underperformance gap that mathematically uncoils directly behind it. Both converge on the exact same September to October 2026 recovery window. The great rotation from unbacked paper assets into hard physical resources is completely in motion. The fundamental ratio is moving. The sovereign global buyers are active and aggressive. The $70 price floor is entirely real and strictly temporary. Silver trading at $76.77 on a down day is the absolute final window of opportunity, before the overarching macroeconomic thesis becomes glaringly obvious to the entire world. The window to position yourself ahead of this historic wealth transfer is rapidly closing. The data is absolute. The sovereign buyers are executing their mandates. If this analysis provided you with the precise clarity required to understand the true macroeconomic reality, hit the like button immediately. Share this critical briefing with anyone currently holding vulnerable fiat paper assets. Subscribe to Faultline Finance to navigate this violent structural rotation alongside us in real time. The mathematical reality does not lie. Position yourself accordingly. I will see you in the next briefing.